Hey everyone, I'm Jeremy Szafron. This is Kitco News. Don't forget to hit subscribe. Now, the latest U.S. service sector data revealed moderate growth for the second consecutive month, while the ISM Services Index holding steady at 51.5, just above contraction. Now, employment growth has essentially stalled, slipping to 50.2, while order backlogs saw their sharpest drop in a year. Now, combined with weak private payroll growth and concerns over inflation, this has left the market in a state of uncertainty, of course, awaiting this week's jobs report, rather. Now, to break down what this means, we welcome back Ted Oakley. He's a managing partner at Oxbow Advisors in Austin, Texas. Good to see you, Ted. Nice to have you back.
You bet, Jeremy. Good to see you.
Okay, let's jump into this ISM because, as I just mentioned, it showed minimal growth, stagnant employment, and of course, backlogs slumping. Now, you've said before the government spending is keeping the economy afloat. How long can this last before we see a deeper impact on growth, or is it starting to dwindle now?
Well, I think, Jeremy, it's beginning to dwindle now. I mean, if you look around at other things, just look at some standard things, but you look at the JOLTS number yesterday, and then you look at job cut announcements and look at basically new home starts. You can go down the list of things that are declining. And one of the things that's happening, and I just spoke to a big retailer today who said that people were slowing down on their payments. So I know it's happening. We tend not to think about it with the stock market where it is, but it's all coming together there. It's a slow disintegration, but it's still happening.
Yeah, I've been going through the data, and to be honest, we're always talking about how negative it is, and I've been trying to find some light in it. But we're seeing signs of a weakening labor market, particularly with job openings falling. But it's worth noting that ADP data wasn't all that bad. I mean, we saw an increase in 99,000 private sector jobs, which, although modest, is still growth. I mean, is there any pockets of resilience in this economy?
I don't see a lot personally. Now, I will say this, something I have noticed is that in multifamily, if you have really high grade, and I'm talking about the best built multifamily in the right spot, I am seeing some of that tick up a little. Some of the buyers come in and buying that and paying up for it. But that's a small segment, see, because that's places where you build an apartment complex and it's a one of a kind almost, in the right place. That's about all I've seen really where that's happening. We don't really see it in many other things right now.
Yeah, I mean, state to state, I was just in Florida not long ago, not looking very good for that market in terms of real estate, and not even to mention commercial. There's some weaknesses here, huh?
Well, residential certainly weakening. And you talk to a lot of residential agents and they'll tell you that, well, we started selling a few more, not many more, but we're selling a few more, but they're 20 or 25% less than they started out. So that's usually not a great sign for that market. I think the problem with the real estate market is not so much the rate, it's the price and then the insurance and taxes you have to pay. If you put all that together, the rate to me becomes a smaller piece of that. And I think that's where people are making a mistake right now.
So where are we here? I mean, Teddy, with government spending maintaining this recession level pace, are we risking a harder fall once spending slows down, and we're starting to see that slow down now? Or is there a way to maintain some momentum through private investment? Is there any money left?
Well, I think there's money left, but what would happen is if you're running 6% deficits, and then, I mean, in a supposedly good economy, and then all of a sudden you do go into a slower economy. And I do find it kind of interesting that people that think that the Fed can just do what they want to do and they'll create a soft landing. The Fed's never really created much of anything. They've always just reacted to things. And I'm sure they think they've got this one under control, but they probably don't. And more than likely, what would happen is, let's say you're running 6% government deficits, and then all of a sudden you slow the economy down, and they have to run 10% deficits or something to try to get it going. All of a sudden you can see that inflation's going to come right back on you. And this time, though, it'll come back a lot harder. And I think that's the problem between the Fed and the fiscal policy is that the fiscal policy is out of control. I mean, nobody's thinking, either party, by the way, nobody even talks about not spending.
Yeah, that word debt isn't really coming up in any of the press that I'm seeing of either candidate right now. Okay, let's talk about, you've mentioned investors are complacent, sticking to the same companies despite signs of this slowing economy we're talking about. Do you think we're at this tipping point where market sentiment shifts, especially with the concentration in the Mag 7? Explain this complacency we're talking about.
Well, let me just give you an example. If you look at the number of 401k plans that just crossed over $1 million, okay, like 450,000 or something. I don't have the exact number, but what I'm trying to say is you have a lot of people that have done really well the last 10 years, and they think it's like that all the time. They have no, even people that have been around longer, they're even mesmerized at this point, and kind of their mind's camouflaged as well, because they can't see it because it's done so well and things are looking right. So the stock market, and to a degree the real estate price, has made people feel like that they're wealthy. And they are, if they want to liquidate everything. But what happens is you go the other way and you'll start having asset prices come down, which is easily to see now. And you'll eventually have that. And that's what causes this. But people are very, very complacent because they haven't had to worry about it. Just think about this. In the last 12 years, you've had one bear market that lasted 5 weeks in 2020. And you have one that lasted 10 months, not quite 10 months in 2022. And everything went back to new highs. And the Fed took care of you and everything was okay. And even when they raised the rates, they were still okay. So see, they're like, okay, everything's okay no matter what. And I think that won't prove to be true, but we'll see. But you always have a bear. People that think you'll never have another bear market, long bear market, or never know anything about history, because you can go back thousands of years. You always have a bear market. You don't know when. There's something will cause it.
Yeah, and as you mentioned, I mean, markets are cyclical. So what's mesmerized them? I mean, we've had all this stimulus go into the market and prop up evaluations. Is that what you're kind of talking about here? I mean, the big question is, when does it all come crashing down, if it does? I mean, that's where everyone wants to get ahead of.
Well, it's usually something, it can be like just a whimper. It doesn't have to be a crash. I mean, you can just roll over sometimes. And the market starts down, and then it goes below a certain level that people are like, well, I thought that would be okay, but it's not. And it creates its own selling. That could happen. You could have a world event happen. There's a lot of things that could go on that would change it. But the primary thing is this. If you look at the forward multiple, it's too high. I'm not saying it's not going to stay there, but if you want to make great buys on the market, really good value buys, that's too high a multiple. And so you have to stop and think, okay, would I be willing to accept more 5% return guaranteed until I can get that? And that's what we do. But most of the people are not doing that. They just plow. They're all in. I've seen so many people over 60 that have a tremendous amount of their liquid net worth. I'm talking about 90% in the stock market. And I don't think they're thinking right, but that's, it's their business.
Yeah. Well, I mean, as you mentioned, your clients over there at Oxbow are worth big money. I mean, a lot of them have had sell-offs, sold some companies, put away a lot of cash. Where are you advising them? I mean, what are you putting them in at this point then?
Well, we have three strategies. I mean, and all three of them have a different objective, but the one strategy is conservative fixed income. And what we had done starting in May and June, as we extended our maturities, we had a tremendous amount of money just in the floating rate. And we went out 6 months, 12, 15, went all the way out to 2 years and some 5 year. As long as we could get close to 5%, because we knew the rates would come down eventually. That's what we've done over there. In the stock accounts, what's happened is we're still buying things, but we buy things that we feel like are really a good value. In other words, something's changed in it, and we've cut back on our big tech names. We own a lot of those names, but not near as much as we used to own. And for accounts, we probably wouldn't even buy them. But we bought a lot more consumer staples. You'll see where we bought energy, healthcare, auto parts, those sorts of things that will do well in bad times. Then we have a high income account that's interesting. We own a lot of oil and gas pipelines, a lot of gold miners. We have a lot of convertibles and preferreds and all sorts of things. A few REITs in that, but it yields a lot. So depending on what somebody's doing, but all of those strategies, every one of those strategies has anywhere between 45% and 60% short-term treasuries.
Could these rising energy prices that we're talking about and seeing in this latest data, could it end up working against these defensive portfolios? I mean, what do you think here?
Well, energy's really been weak here the last few weeks. It's down to $70 on West Texas. And what usually happens is it does fall. Energy falls. That's why you get the better buys just as you're going into recession, because you can see people quit using it. But on the other side, you have to have a lot of energy to really boost the economy when it comes out of that. So you want to own energy coming off of that for sure. And we'll own some energy even through slower economic times, because there's certain things you have to have, and one of them is gasoline. I know everybody thinks that EV will save the times, but it's a very, very small percentage. So you have to have gasoline, you have to have food, and you have to have a place to live. So those things you have to have, and they maybe they drift off a little bit during recessions, but you still have to buy them.
Yeah, and to your point, I saw news today that Volvo is kind of shifting. They're pivoting. No more EVs for them. They're not focusing on just being an EV company anymore, to your point. Okay, we know right now the market's just talking about what is going to happen with the Fed's rate cuts. Is it going to be 25 basis points? Some people in the 50 basis points camp. I mean, you can tell me what you think you're going to see in terms of the Fed's rate cuts, but do you think that we're heading towards a soft landing, or are we looking at a more significant recession as layoffs continue to rise here?
Oh, I don't really think I think that soft landing talk just was dreamed up. You don't see that very often. You're either really slowing down or you're not, and what happens is it start out that way. Yeah, I think, well, they're going to be able to handle it. If you ask me to put a bet down on the Fed on whether they could handle something, an outcome other than just throwing money at the markets to get them up. They could do that on the way up. Yeah. On the way down, different story, because they judge things late, and they're real late on knowing what's going on in the economy. Always are. And so I suspect that they will be this time too. And it won't be just, if it's going to be a landing, it'll be a harder landing than people expect.
Yeah, it's almost sounding like dropping knives. You're grabbing knives in thin air here. Okay, I saw you mention that the only ones that are making money in this market and kind of keeping the economy afloat is the U.S.'s top 20%. Ted, explain the disconnect between Wall Street and Main Street here. I mean, it feels huge.
Oh, it's very large, actually. And I think a lot of people on Wall Street were never on Main Street anyway. They were basically in the elite segment, and they went to those schools, did those things. I'm not knocking that, okay? I'm just saying they have no capacity to know what's going on Main Street. Now, you're looking at a guy here that grew up extremely poor, so I talk to a lot of people, get a lot of input just anywhere, in a cab, on the elevator, wherever. And I can tell you that the difference is those people down in that lower section, they don't own stocks and bonds. They don't own this high dollar real estate. They're just trying to make a living right now. And that's getting harder and harder and harder for them. And what happens on Wall Street is Wall Street doesn't really care. They're basically for Wall Street. Always have been. My first job on Wall Street was a long time ago, and I was in New York, and it's never changed a lot. And so what happens is, as long as the music's playing, they're going to go for it, no matter what. And I've seen too many strategists fired up there because they got bearish, and they're going to always be bullish and always try to keep people in the markets, and that's what they do, and that's what they're doing right now.
Yeah, amen. I mean, it'll be interesting watching it when it comes unraveling. Do you think that this, this rate cut everyone's talking that's coming up, be it 25, 50 basis points, you think it's going to prop up confidence long enough to avoid the shock?
Well, I think it's already there, Jeremy, because what happens is, and I tell people this, we own a lot of money in the floating rate treasury, which pays about 5.15, 5.11 now. And what happens is, I tell them that if the Fed goes, let's say go down a half a point, 5.5% to 5% on the Fed funds, that short paper will still be paying about 4.75 or 4.80, which is not a bad return. And then you'll have to wait and see what they do at the next one. Now, my guess is if they do that one, they'll eventually have to do more. But I think a lot of it's in there right now at this point. It could be like like '08 and different times when I've seen they lower the rates and the market goes down because people think, hey, this thing's not so great out here right now. We really don't invest on the Fed. So that's just, I know that everybody, if you think about it, Jeremy, everybody talks about it. All the people talk about are the Fed. They don't ever talk about value and what can you get for a return, cash flow, that sort of thing. That's what we look at. And I think the world in general has just become money, money, money. If you think about it, everything's money. I don't care what it is. It's just about money. And so that top 20%, it's all about the money. And I think that's where we are right now, unfortunately, as a society.
Yeah, unfortunate as it is. Okay, well, we'll continue to watch for these job numbers. Ted Oakley, managing partner at Oxbow Advisors, joining us from Texas today. Thanks, my friend. Appreciate your time on this.
You bet, Jeremy. Thank you.
Thank you. I'm Jeremy Szafron for all of us here at Kitco News. Don't forget to hit that notification button. We got great content all week long. We'll see you next time.